Hello students and welcome to the lecture. So students, as we know that we are covering the financial system and basically what we are covering in it, we are covering the mutual funds. Okay. This is a topic we are covering upon and these are the subtopics or you can say the headings we have scheduled for the discussion under this series. Like we will start with the introduction part. Okay. Then we will see the basic history. Then we will see the growth of the mutual fund industries. Okay. Then the types of mutual funds, regulation, investors participation, and then the conclusion. Okay, so these are the topics we had scheduled for the discussion. So far we have completed the introduction part, basic history. Okay, we are left with the, or you can say we were discussing the growth of mutual fund industries in the previous lecture. What topics we are left with? We are left with the types of mutual funds, regulations, investors participation, and the conclusion. Okay, so that is the picture we have created so far altogether. So basically we will start from where we had you can say left it in the previous lecture. Okay, so basically we have you can say left with this AUM. Now we are going to continue further. So here we have the growth of the mutual fund industries. Like we have seen the introduction, what do you mean by the mutual funds? Okay, we have seen the basic history from the UTI till the, you can say, the direct plan. Okay, all of the series, all of the things we have covered. Now what we have the diversification of products. Okay, like when we talk about the mutual funds, or in the, you can say when we talk about the 1963, then 1963 when the unit trust of India was formed. Okay, so basically this time when the mutual funds originally started. Okay, so in mutual funds there is a one basic thing. And what was that? The basic thing was that it was just only a money pooling scheme. Okay, it was just only a money pooling scheme. Okay, it means that if you having a money, you could contribute into the fund, then the fund will be utilized to buy some shares, securities, and this and all. Okay, but over the period of time, due to the, you can say, the suitability, and you can say due to the encouragement to the investors, the mutual fund industry has evolved itself. Okay, and nowadays it is no longer just a money pooling scheme, but it is more than of it. And what do you mean by when we say that more than of it? So basically the mutual fund industry in India has diversified its products, offering to cater to the varying risk profiles and investors' objective of the investment objectives of the investors. Okay, so you could say like when it was evolving, okay, then it has you can say expanded its branch network to the various areas. Okay, where the risk also varies. Okay, and the investment objectives. It means that the objectives through which the investors is making investments is also varying. Okay, so this is the things. All right, so let's start. So basically the first product which was introduced by the, you can say, the mutual fund industry was the equity funds. These funds investment primarily in the stocks and are suitable for investors seeking capital appreciation over the long term. Okay, so basically if we talk about the equity funds, okay, then it is very much similar to the equity shares, right? So what do you mean by the equity shares? Basically we had you can say discussed that suppose if there is any company, let's say that there is a company of XYZ. Okay, so whenever the XYZ launches a share, so there is a category of share which we call as an equity share, right? equity share. Okay, the equity share, you can say it's a such kind of shares which generally offers the ownership in the organization. Okay, so suppose you could say if the company's total wealth is rupees 100 crores, or you can say total worth. Okay, so the company has launches a 10 shares of worth 10 crore each. Okay, and if you had purchased, suppose, 2 shares out of this, it means that how much equity you are holding? You are holding 20% equity. Why? Because 20 crores of 100 crores is 20%, right? So you have the 20% equity, or you can say you having the 20% ownership, right? That is the concept of the equity shares. Okay, similar thing is the equity funds. Okay, for example, you could say there are 6 investors, all right, and there is a company called the XYZ. Okay, so the XYZ is offering 100 crore shares as 10 shares, or you can say 1 share at 10 crores. Okay, all of you have invested some of the amount like 10 crores. Okay, like you can say 5 crores, all right, like 10 crores, then 5 crores, 5 crores, 10 crores. All right, this has been the contribution made by the each and every investor or the fund member. So if we, you could say, like if we added them up, so 10 10 10 30 30 10 40 45 crores. How much amount you have got? You have got 45 crores. All right, so suppose with 45 crores, how many shares you could you could hold? You could hold 45% of equity, right? All right, how? Because you could hold the 45 shares by paying the 10 crore rupees, or basically it will be like you can say 4.5, all right, but when you round it up, it will be like 45%. Okay, so your fund having the 45% equity in the XYZ. So the funds which have been arranged to buy the equity in some you can say organization, that particular shares are known as the equity funds. Okay, so remember, the equity funds are basically raised to buy the equity into the some company. All right, and here you could see that there is a one thing written down here: seeking capital appreciation over the long time. What does it mean? Come on, if you have revised the previous lecture, then it will be a test for your memory and for your expertise which you have gained so far. Okay, like I'm asking you, what does it mean, capital appreciation over a long time? You have 15 seconds to think, then I will give you the answer. Your time starts now. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13th, 14th, 15th. That time's up. So basically, when we talk about the equity share, okay, and when we talk about the equity holding, there is a one thing which I had told you. What was that? Equity offers the ownership, right? That is the thing I had told you. Okay, equity offers the ownership. There is no fixed returns. All right, it means that when you have become the partner, or you had you can say acquired the ownership in some company, then you have become the person who will be liable for the wear and tear of the company. Okay, whether the returns will be high or the low, you will be the one who will suffer a lot, right? So that's why here this is not the short term. It means that if you have bought, you can say if you had purchased a 45% equity doesn't mean that you will get the returns on the same time. Okay, because right now you have become the partner of the XYZ. So whatever the XYZ will experience, the same is implicated on yourself and your fund also. All right, that's why it is called the long term, not the short term. Because the company and the organization of which shares you have bought, the company and the organization is not entitled to give you the fixed return, because now you are not the investor, but you are the part of this organization. All right. So whatever the organization is experiencing, whether it's a boom or you can say whether it's a discuss, you will be the part of it. All right. So that's how the equity system works. So if you had revised the previous one, then that will be the very, you can say, easy question for you. If you haven't revised, then you must revise. Okay. Thereafter, next is the debt funds. Okay. Now, there is a one thing which I will tell you, that most of you maybe pronounce it as a debt. Okay, no, because it is known as debt. Why? Because B is silent here. Okay, doesn't matter how it is written down, it will be always pronounced as debt. Okay, these funds invest in the fixed income securities such as bonds and suitable for investors seeking regular income and the capital preservation. So basically, when we talk about the debt funds, then basically we are talking about the debentures or the bonds. Okay, that's also we had discussed. I had told you that when you go to the debentures or the bonds, okay, so there is no, you can say, no ownership. All right. For example, suppose there is any organization. Let's have an example of this XYZ. Okay, they required rupees 100 crores for their further expansion, business operations, and whatsoever you could call it. 100 crores they required. Okay, so what they had did, they had launched a 10 shares at the rate 10 crore each. All right, 10 shares at the rate 10 crores each. That is the deal. All right, so right now there are your 6 fund members. All right, it means that suppose 10, 5, 10, 5, 5, 10. So just merge it, it will be rupees 45 crores. Okay, so if this is you can say the scene 10 crore shares, so suppose make it 10. So that will be your 50 crores. So how much funding you had arranged? You have arranged the 50 crores. It means that that is the total value of your fund. Okay, so if you utilize this 50 crores, so it means that how many shares you could buy? You could buy 5 shares, because each share costs 10 crores. So if you go by the value, then you will be able to buy only 10 shares. Sorry, 5 shares. Okay, so you have bought 5 shares. So if we go to the equity, then it means that you have become the partner of 50%. But we are talking about the debentures and bonds, which are not, you can say, the way to acquire the ownership in any organization. So what is happening here? That the XYZ has issued the debenture and the bonds, which is generally comes with the fixed returns, and thus they do not have offer any kind of ownership. So you will not entitled to holding the 50% equity or the 50% ownership in the XYZ. You are just a shareholder who is holding the 5 shares or 50 crores investment in the XYZ. Okay, and this you will be able to get the fixed return. It means that doesn't matter whether the company profile is on a high or low, you are not entitled to increase your return or decrease. You will be able to receive the fixed interest. Suppose 10% has been promised before launching the shares. Okay, so what does it mean? 50 is 10% is rupees 5 crores. Okay. On the periodic basis, you will receive 5 crores. Okay. And these 5 crores will be distributed amongst the group as per the contribution they had made in the total value of the fund. Okay. So this is called the debentures or the bond. So basically you could say like the funds which have been raised to buy the debentures or bonds in any organization. This is known as the what? What do we call it? We call it as a debt funds. Okay, because this is only creating the debt on some organization, it is not offering you any kind of ownership. Okay, so it ensures the regular income and the capital preservation. All right, because you are not entitled to suffer the wear and tear of the organization. Why? Because you are not having any kind of ownership in it. Hybrid funds. These funds invest in the mix of equity and the debt instruments, offering a balanced approach to risk and return. So basically, if we go by the hybrid, so first of all, we are required to understand the hybrid. What do you mean by the hybrid? Okay, so whenever we're talking about the hybrids, then always we're talking about two or more things, or you can say there is a one word which I am just inherited. Okay, two or more things are present or inherited into one single entity. So whenever two or more things are present or inherited into one single entity, always the situation will lead us to the hybrid situation. Okay. Similar thing, if you look at here, you will find it. These funds invest in the mix of equity and the debt instruments, offering a balanced approach to risk and return. Like equity is totally different. Okay. Debt instruments is totally different. Okay. So does the risk and the return. So let's understand. Suppose there is any organization. Look, this one. XYZ. This is an organization. Okay. XYZ is basically holding 100 crore shares. Okay. So they launch, you could say 100 shares at rupees 1 crore each. That's the value, okay, which they are offering to the market. So if we go by this, then what happened? That suppose 6 fund members again came forward. All right. And what they did, they basically, you could say, contributed the fund like 10 crores, 20 crores, 5 crores, 5 crores, 10 crores, 5 crores. All right. So when we merge it, how much amount we are getting? 10, 10, 20, 30, 30, 10, 40, 50, 55. Just make it 10. Okay. So how much is it? It is 5, 5, 10, 10, 20, 20, 30, 50, 60. Total is 60 crores. Right. So what does 60 crores signifies? That it is the total fund value, right? Total fund value. Okay, 60 crores. So what happened that you utilize this 60 crores to buy the shares? It means that how many shares you will be able to buy? 60 shares at 60 crores. Why? Because one share cost 1 crore. So if we are holding 60 shares, it means that how much amount you have invested? 60 crores you have invested. Okay. So now this is the condition of the hybrid. Okay. Which means that neither the shares which you have bought are totally on the equity nor on the debt. It means that suppose the organization has said whatever share percentage you have bought, 50% will be on equity. Okay, and the 50% is on the debt. Okay, doesn't matter how many shares you will be buy. Always there will be a condition like the 50% is on equity and the 50% is on debt. Got it? So if we try to broke down, or you can say the breakdown the situation. It means that 50% means 30 shares are on the equity basis. Got it? And the 30 shares are on the depth basis. So technically, what is the situation? That 30 crores equity, 30 crores debt. So on this 30 crores, you will be eligible to get fixed returns, right? And on these 30 crores, you will be a partner or entitled to bear risk. Okay, so that is the situation of the hybrid. Hybrid is a balanced approach of the fixed returns and the risk association. Okay, which means that on the 30 crores which will be invested into the debt form, you do not have to worry about it. You will receive the fixed returns. But the 30 crores which will be invested on the equity basis and which will bring you the 30% ownership or the equity in the XYZ, then on those 30 crores, you will be eligible to get the capital appreciation in the near future if it's happened, or you can say vulnerable to bear the risk if anything mishappens. All right. So that's how the hybrid funds work. So the funds which have been raised to invest into the hybrid shares, these funds are known as the hybrid funds. Got it? Index funds and the exchange traded funds. Okay. These funds aim to replicate the performance of a specific index and provide investors with a low-cost way to invest in a diversified portfolio of the securities. Just you could say, just read out the definition. We will discuss them in detail in the upcoming lecture. All right, or you can say in the further way. All right. So here now we have the distribution channel. We have seen the, you could say, the products which have been launched into the mutual fund industries over the period of time. All right. So the mutual fund industry has expanded its distribution network to reach a larger investor base. All right. Includes tie-ups with the banks and the financial institutions to distribute mutual funds products to their branches and online platforms. Like, just decode it. Since 1963 to 2014, right? We had seen that the mutual fund industry has been on the rise, right? It means that the industry have done something surely to attract more and more people. All right. So basically, it means that they had enlarged their marketing channels and distribution channels, right? Marketing and the distribution channels. What does it mean? It means that first, through the marketing, they have, you can say, spread the awareness amongst the investors, among the people who are having the small savings, who want to enter into the share in the stock market but does not having the confidence, do not having the expertise and all the things. All right. Thereafter, distribution channel. Those who have come forward, how those will be benefited, that comes under the distribution channel. Okay. Like how the things could be granted to them, how the things could be, you can say, transferred to them. All right. So this is called the growth of the mutual fund industry or the distribution channels. All right. So students, basically in this lecture, we have covered till here. In the next lecture, we will, you can say, start from here. Till then, just revise all the facts and figures we have discussed in this lecture. Be ready for the another lecture. With this note, let's end this lecture. And what do we say? We say thank you.